All right, traders, welcome back. Advantages of future spreads, our second lesson. I'm very thankful again to have you guys here. In the meantime, while I'm chatting real quick, let's put the disclaimer up here that we got to try to do, or do by law, we have to do on every publicity here that we send out. But again, thanks for coming, guys. Lesson 1 through 4, again, of our boot camp, more basic stuff that you may have heard on a webinar somewhere that got you this far enough to come here. But we're going to repeat it because it's part of a step-by-step course that we want everyone to take notes, okay? So let's go ahead and get into some the advantages. Some of them you may know, some might be new to you, okay? Spreads, they offer a great return on investment than is possible with outright futures because you post far less margin to the potential same amount of return. Okay, this is not always possible, but it can happen most of the time. So again, we've spoken about span margin, how when we put on a spread trade, we're putting on two legs of like the same market or similar markets. And because that, the exchanges recognize that our risk is limited compared to just trading it outright, like a one contract by itself of something like the S&P or crude oil or what have you. They reduce our margin. As you see here in the second bullet point, spreads require about 20 to 95% less margin. Don't know where the lower 20 is from. I think just to be conservative, we put that there, but closer towards anywhere from 70 up to 95% is what we see most of the time. Less margin needed for the outright contracts on futures spreads. Now, this is why when an outright makes a strong move, we may not reap the bigger rewards that the outright does, but 8 to 9 times out of 10, we are in a safer position, and then we can still profit sometime as much than rather than losing outright positions most of the time. Okay, so it's costing us less money to get into potentially the same reward, a little bit less. Be honest, it's less risk, less reward, but at times we get rewarded with just as much reward as an outright. It's kind of where I wanted to go. It's better to be safe this way, guys. You still get like a good pulse of the market. You get involved with the markets. You get engaged with the markets. And you're not taking that very, very tough risk. You'll be stopped out all the time. And frankly, trading outrights, unless you have a lot of money, like maybe over $500,000 to $1 million in your account, if you don't have really, really wide stops and risk levels, then you can't just put on an outright trade and just walk away. You'll be then day trading, and there's a lot of more stresses that go to that. So this is a huge, huge advantage to remember, guys. Always remember this. This is key. These are key reasons why you're here and why you're going to be doing this. This is overall all reduction of anxiety and stress. Okay, and let's go ahead and look at an example. I'm going to pull up my Daniel's trading account. That's where as of the time I'm recording this, that's where I trade my spread trades out of, folks. They're out of Chicago. Cool guys. If you guys need to get in touch with anybody, let me know. I could put you in touch with them. There's other people I talk to and work with. But at the time right now that I'm recording this, that's where I place my trades through. Daniel's Trading. I use a platform called DT Pro. I don't really use it for much charting. I'm not technically looking at these much from there. I'm just putting my trades on from there. So in this next quick clip, I'll just kind of show you an example of a span margin. I'll also look up the CME tool. There's a source on CME, Chicago Mercantile Exchange Group.com, that'll allow you to pull up a commodity and then look at what the reduced span margin is on a particular trade if you wanted to take one. Hey guys, I'm back. This is the Daniel's trading platform that I have set up. I'm not going to get too much into how I do all this setup part. Just want to talk about span margin. They offer me a pretty cool tool here in the trading tab of the DT Pro platform. And I like using them because I get a depth of market, by the way, guys. Side note on the spreads. You guys have seen this in some of my webinars and things like that. So like the actual spread itself, when I create a spread here, I can actually see the actual depth of market on it. Here's a copper spread, for example, that I'm actually currently in right now. And I can see the actual relative ratios and the depth of it, how many people are in this, okay, instead of legging into stuff. So, but what I want to do is I go to trading, and they have a cool calculator here that I'll use, margin calculator, okay. So under the margin calculator, I'm just going to pull up, I'm going to start typing the contract, and it'll pull up all the crude oil contracts that are active and available, all the front month here, which is a spot month, and then all the following months. So let's say I want to do like May versus June, which is this K versus M. I know they're funky again, guys. Grammar and letters and things with the board is weird. But if you go to like the CME group site here, you can pull up like the crude oil futures settlements and see all the active contracts, all the active months, see where all the volume is. We'll get into that later. This is just a check span. Let's say May and June. May is, I'm going to go here and pull this up, is going to be, I believe it's K. Sometimes I forget these two. It's K. Well, let's say like I'm going to sell that spread, or, you know, that means I'm going to basically sell the front month. I'm going to buy June. All right, so I'm going to put this and M. Okay, M is June and K is May. Retarded, but that's just how it is. I'm going to also enable these by picking the quantity. Like I'm going to sell that month and I'm going to buy June. So when I do that, it automatically will enable these, and then I hit this calculate button, right? It'll calculate for me exactly what my margin is going to cost to trade that spread. Now, if I take off just like one of these things and calculate again, you guys see what I'm talking about? It costs $4,400 overnight to carry, over $4,400 to carry one crude oil contract. Not only that, this thing moves crazy, guys. For those of you that have been here from different future camps and schools and stuff, you know it's very hard to trade crude oil. I mean, on a technical level too, you get whipped around very, very aggressively. And you can't play tight games. You can't play tight stops in this market. You're going to get stopped all the time. You get whipped and there's slippage everywhere. So, you know, trading just crude oil by itself versus a spread, one, you get a lot more liquidity. We've gone through that. We'll show that to you again. But again, when we add the spread, look at our we're reducing volatility and we're reducing risk. Our reward is not that bad. Our reward versus what we put in is so much greater than this potentially that it's so much more worth trading spreads over outrights. You know, this is a huge advantage. Let's get back to our slide here. Spreads, they trend much often, even when the outright is flat for longer periods of time. Insiders and market movers have a harder time to stop you out of a spread versus a single position, which is why they also trend more versus the volatile moves of an outright. If we take crude oil, for example, that'd be an easy one. Let me pull up a couple of charts and let's take a look at that. Here's an example of crude oil from January of 2018, the beginning of last year, all the way through. We can see that it uptrended very slowly, but more or less through the year stayed in this range of between like $64 and $75, $64, $75. Then towards the winter, just slammed on down, and it trended well on as a regular seasonal pattern possibly would have done anyway, right? But during the year, the opportunities were pretty limited. Let me pull up here's a crude oil calendar spread from around January of last year too. It ranged a little bit at the beginning of the year when the rest of the market was doing the same. But once it hit a high on a relative ratio between the two calendars that I have displayed here, okay, this thing trended really nicely. And even as you can see, the point of entry from like right before the summertime all the way through the rest of the year until now, you know, if you were just keep rolling this thing forward, you're in nothing but a profit. You're not getting stopped out or anything. Okay, less reward, but less risk. You're still making pretty nice rewards. And then imagine multiplying contracts. So it's safer trading, peace of mind. You're engaged in the market. Okay, you're trending better with the market too. You're taking that volatility out. This isn't the cleanest example, but hopefully you get the gist of things. This is RBOB gas. It's another energy commodity. Okay, this is the price of fuel. Okay, RBOB. It's /RB. And this is like 30-day up, down, up, down, up, down movement. Let me pull up a calendar. Let's go ahead and use, and by the way, guys, I use different platforms for different things. There's reasons why I do that. Let's see if we can pull up. Where's the 30-day on? This is just 1 month here. RBH19, my bad. Let's pull up a calendar. Maybe send that. A little bit more of a trend, right? Well, there's a calendar spread, same deal, 30-day, 5-minute chart, and it's just much more of a trend. Okay, and it's just one contract versus another contract. Allows you to get in the trade, get involved in the markets, be engaged without getting, massively stopped out. Less reward, but less risk. It's okay. There's nothing wrong with that. All right, advantages of future spreads. Another one is seasonal trading is a core trading system with spread traders. Some may use backwardation and or carrying charge differentials and trading filters. Now, I personally, at the time I'm recording this, don't trade like this. I look at it, I understand it, and that's exactly what I want you guys to do too, is to know what it is and understand it. Make notes of this right here, maybe snapshot it, or come back to it, or just make note of it and study it a little bit. Understand some of the professional traders in the spread trading market use this as their strategy, okay? Solely. They will look for prices, okay, in the front month normally, okay? Normally. This brown line over here, guys, where it says contango, okay? That is when the markets are normal in the deliverables. Okay, the products that are like physical deliveries, your foods, your cattle, your agriculture, your live cattle, all these stuff. Their normal pricing like this model is basically because assumption that always there's a cost to do business to store products for the future. Farmers and producers and all that stuff are storing things. There's storage fees, there's labor to store them, to pool them, and equipment. Also, there's interest from banks involved in storage of stuff and supply. So, always when you look at calendars and the different months, even on CME, you'll notice the prices of the futures and commodities more expensive in the later months, which is called the back months. And thus, this is called the contango market. Some people occasionally will look for a skew in this kind of stuff where the front month becomes more expensive than the back months. Okay, this tends to happen a lot with crude oil. Let's say a sudden supply or shortage plus a hurricane or something causes the need and demand to move forward on crude oil. This happens a lot in energy. And so they'll bring the supply out of the back months into the front, making the front month more expensive. Okay, this is an example. And some people will trade this skew. They'll look for this kind of skew. And this is not called arbitrage for some of you out there. Arbitrage is a whole different thing. It's like a cousin of spread trading, but it's not an arbitrage trade here. And so what they'll do is they'll sell this off and they'll buy the back month and try to take advantage of the backwardation of the market. Make a note of that, guys. This is part of our game here in the spread trading. We it's part of it. It's relative to what we do. I don't use it too much. There's just so many seasonal opportunities. I get in some of the more easier stuff, but I'm always open, especially to members in our group as we grow in our private group. I really look forward to hearing from a lot of people share their experience with this, be open and grow with this. This is something that can really be of interest to some people and to some people not. So we want to be open to this, understand the grammar, understand what exists out there in our market. Same thing like guys in the interest markets, okay, like the bonds and the yields, the U.S. treasuries and debts. There's different words they use for the same thing. I took a snapshot of this off the internet. They call the yield curve, like the 5-year treasury note versus the 10-year treasury note versus the 30. There's a curvature in that. Some people use this to measure a possible recession, or the feds will use this to measure economic strength, and so then they'll start boosting, interest rates on us. They'll use this as indicators. Some of you out there already know what this is, and again, I hope you share this with everyone else. Let's all educate each other on this. If you're out there using it, I got involved when before spread trading and with the interest to learn this and become good at it. I lost some interest. I don't do yield curve trading much. And my interest originally was because I was outright trading the 10-year note, the 10-year ZN note, which was a really high liquid interest rate note in the treasuries. So that's why my interest for then came to this and led me into spread trading commodities. That's how I ended up here too, is via this. This was a channel, so I have a lot of respect for it and for the people that know about the yield curves. But rather than them calling the yield curve, hey, the yield curve is in a contango, they'll say, hey, it's normal. When it starts getting flat, of course, it's flat. And as you see at the end there, instead of saying, hey, the yield curve is in backwardation, like we use that same term maybe in crude oil, they'll just say the yield curve is inverted. So these terms, again, like when I mentioned in some prior webinars, like, hey, it could be like confusing because the exchange, they just have different words for everything. Once you get a hang of our little world here, and it becomes part of you, it won't be. And then how you decide to use it and how you want to use it, complete respect to you on that. I appreciate every single one of these aspects because it's part of our family of trading. Trading spread trades, trading relative trading, price difference between another price difference. So I just wanted to share that with you guys, okay? Poof. Mind blown. I know. Maybe some of you are. I know I was. And sometimes I still am when I sit there and I try to read a lot of that stuff. I'll buy books. I buy a lot of motivational books to keep me in leadership and things like that. But I like to dive in and still get good at learning these things. And occasionally when I read like exchange book data, it's like, poof, that's me right there at night. My wife goes, honey, you smoking something again? I'm like, no, you don't let me smoke anymore. Poof. Anyways. Another advantage of future spreads. Spreads, unlike options, they do not decay with time. Okay, they expire, but they do not decay. So this is a huge advantage for a spread trader too. Maybe, perhaps, we're in these contracts far before the spot months expire. And, most of the time, if, we're in a trade that long because it's going so good, you may want to consider just completely killing off the trade and just open up another one in the later months. You don't have to roll or anything. But unlike an option trade, guys that are here from the stock world or even commodity options, options expire and they expire worthless, and they have a thing called theta where, not to get too fancy smancy, they start decaying. So even like if you start becoming in a profit zone towards like the last month or so, they're actual like they have an expiration, like they mold up on you and the profit margins start disappearing, even though you're in the right direction. We don't, futures, that doesn't happen. Contracts expire. Some expire monthly, like the energy stuff. Some expire 4 times a year. But, they just go into a time where, what's called rollovers. And you just got to start being aware of what you're trading and when rollovers are. As a group, we'll probably start announcing things to just kind of give you a heads up and an edge in case you slip. We all slip sometimes. And it's part of also teams is to remind each other, just like in a trading firm, people remind each other things. I know I never worked in an institute, but I know several people that have talked to me countless hours of the lifestyles behind it. And one guy even mentioned just by them screaming everything out loud to themselves, it'll remind someone next to them about something and help them out possibly into, not getting into something or getting out of something if they're trading, especially 2 different kind of instruments from one desk to another, bonds versus, the S&P and things like that. I didn't really have to display this. Maybe it helps, but there's a sample of Tesla's option chain. This is just like the different expiry months. I don't want this to confuse anybody, but just, so every single one of these strike prices here, 220, 225, 230, 235, 240, 245, these are all different strike prices, and you can buy calls or puts against the current price here of what Tesla is, and you're basically either going to bet up or down, right? There's spread traders in here too. It's a different kind of spread trade, okay? But basically all these things, on top of it being so another, confusing system, more complicated written than it should be. It's more complicated written than it should be, in my opinion. But All these things expire, and they have expiration dates, and all these expiration dates are here. And then, like, even a few days, a month before into it, they start rotting on you. Like, it's called decay. And it sucks because even when you're right, um, it just seems like your money is just disappearing and things like that. So, anyway, that's a option. Okay. That's an option table there. That's what that looks like. And depending on your broker, you can enter and exit spreads using an actual spread order or using a depth of market. You may at a time need to leg in and out of a spread, but we try to optimize this in order to avoid too much slippage per contract. Okay, you can set stops on depth of markets too, and on your spreads. And what is that? It's what I was showing you earlier. Let me pull that up. All right, that's pretty much this thing right here, depth of market, your price ladder. You can enter orders in and out of these things by left clicking on the limit on the buy, or left clicking on the right side if you want to sell. If you want to place a pending order there, you would just left click on that price of that ratio. And that's cool. You see all that volume in there? This is a copper spread. What if I go to metal and just click on the regular copper? Look how thin that is. It was like hardly any players there. And if there is, and like one big guy comes in here and sells 100 contracts and you're in here, you're going to get ran over. This is what happens a lot to regular outright traders, and they know it. I just don't know if some people out there really know about spreads yet. If not, you can invite them here. Here's a copper spread. Look at that thickness there. Look at all the participants. These are producers. These are big institutions. These are jewelers that create jewelry. These are smart speculators, big banks that know, about this stuff. Now you can get involved in it. You're here. So that's what that is. When you get really good, or if you're a technical trader already, you could start using directional bias as a spread trade. Ultimately, in a spread, we are looking at directional bias, but you can even do shorter term and start getting a little aggressive when you get advanced and confident and get closer to like the spot months, the front months. You can start doing things like, kind of getting cute, you'd call it. Again, you're reducing the volatility on the outright. You're reducing overnight margins. You're still being engaged in the markets that you normally would be too expensive to do, like on that crude oil margin. You can come up and probably go on the next month forward and the following month. It's going to get aggressive on you more than, going out further. But you can get like that. You can get, cute with it. You can get directional and say, hey, I'm technical trading a, crude oil chart, and I see it at a certain level, which we're going to get into a little technical section later on. And you decide to just do a straight shorter term, play. You make a little bit of money just on that short term direction play. But you just not want to take that full outright risk. And that's what you can do. You can take advantage of that. For those of you that don't know this will excite you even more. And you'll probably be sharing this with people because it is exciting information, guys. For those of you that don't know, or for those of you who even forgot, that haven't been that active in trading futures and commodities, there is an awesome tax advantage versus just outright stock trading, where it's a 60-40 rule. It's an IRS section rule 1256. You can Google this. And instead of having to pay 100% of your total profits for the year as a capital gains, short-term capital gains tax, like even, house flipping and things, 60% of it goes towards a longer-term capital gains, so it's a smaller bracket, and 40% is on your shorter term. So it's a good tax advantage. It's a simpler form too. I file myself every year on top of my regular TurboTax stuff at home and my small businesses, and it's just much simpler. It's a simple form, and it's a 1256. So you can look that up. That's another awesome advantage. Time saving. So we normally trade our positions. They last within about 4 to 6 weeks long on average. Sometimes the markets, they give us what's called a gift. They allow us to close the trade out much quicker. And but for the most part, this type of trading, it gives us a much more anxiety-free and time freedom to run other operations in our lives, no matter what that is in your life. Another business, another occupation, or just, spending time with your family. If you're in semi-retirement, it gives you that freedom. You're not sitting at a screen at least unless you decide to, if that's your own personal decision, but you're not required to. These are like the only cons that I've found, and I can't find anything much worse on spread trading. Because we are unlimited volatility risk and using less money to get in a spread, our reward is limited too. However, do not let this discourage you. Most professional traders that last for decades in this game, they're spread traders. Okay? There is a higher commission now. Why? We are trading more than one contract per spread. So technically, per se, it costs more to trade on a commission level, a spread trade, but then, it is a multi-contract deal. So, and again, look at all of our advantages versus these cons. So we have a lot more pros working for us than against us. And feeling excited yet? I know I am. I know every morning I wake up or at night when I think about everybody else and what kind of trades we can put on and win and just share happiness together. It really excites me. It really, really does. Finding opportunities like that, like a stock market scanner, they're very important to a spread trader. There's several research tools out there, services or platforms. They're very important in the future success and survival of a spread trader. Currently, as of the time I'm recording this module, this boot camp, I do use a platform called Season Algo. I do not get financially compensated, guys, by these people. This gentleman is in like Czech Republic somewhere. By coincidence, the same country as my wife. I like to travel there. The dollar is strong. It's an awesome place to go. The people are great. That's just on the side. But that's where this dude comes from. They have good communication for the most part, and at the end of the day, it helps make me money, and it's more affordable. I've looked at other things that are available more domestic here to the U.S., and it's cost a lot more money. Practically does the same thing. Some are much more technical out there and advanced, I have to admit it. But this is something I like because it's affordable. Consider it as part of your investment in your business, as part of doing cost. At the time I made this, I see that they're just charging a $33 a month flat fee. It used to be as low as $33 a month if you like prepaid for the whole year. I emailed them on this, and all I got back was that this is the current pricing as of now. So, and you do get some kind of a free trial. It looks like they're a demo. Now, please contact me, bootcamp members, on this. Because at the time that I'm making this, I don't have anything with them as far as special discounts for our current subscribers. I wanted to work on that for you guys up front ahead of time. But I believe at the time we were making this, they wanted to audit our course too. So that's just where it is hanging now. I wasn't going to let that stop us from moving forward. This is a minimal cost. It's part of the cost of doing business, guys. If I can get you a better deal at the time you're watching this, email me or contact me through the Facebook or however you've been in touch with me, and I will see what I have in place with them. If I can get something better for you, get you a little savings per year, then we'll do it. I have no problem helping you out on that. Me, I'm a full subscriber. I don't get any discounts. I pay for this out of pocket. Okay? And I think that's going to be the end of this lesson, guys. We'll see you on lesson 3.